Hey there, welcome back everyone. Big moves today, and this one's not just noise. Over the past 2 days, October 16th and 17th, US regional banks have tumbled after disclosures at Zions and Western Alliance, and stress is spilling into global markets. You might be asking, what does this mean for my portfolio, especially AI and genomic stocks? Should I worry or is this another shakeout? I'm also thinking the same, and here are my personal opinions. Let me be clear, this moment is more than a blip. Financial shocks like this don't just rattle banks, they shake the funding pipelines, risk appetite, and sentiment across innovation sectors. When lenders grow cautious or interest rates climb, the ripple effect reaches capital-intensive, research-driven firms. Those kinds of companies tend to feel the pain first. Now, this is not 2008 redux. The world is different. Regulators and banks have tougher rules, higher capital buffers, and more stress testing. But that doesn't mean all danger is gone. Exposures to non-bank credit, private credit channels, and fraud still remain real risk. Consider this, Microsoft's latest balance sheet shows over 90 billion plus in cash and short-term investments. Nvidia also maintains high liquidity, and in biotech, CRISPR Therapeutics reported 1.7 to 1.9 billion in cash and marketable securities recently. Those are big war chests and they give flexibility, but liquidity doesn't immunize you against valuation compression or funding squeezes in later stages. Over the past year, we have already seen signs. In high interest rate environments, venture funding to biotech and early stage companies tends to slow down. The tougher credit climate tends to weed out weaker players and prop up firms with more resilience. Here are the signals I'm watching, and that is cash and liquidity trends, are big platforms and biotech names preserving or even increasing their cash reserves. The other thing I'm watching is revenue and execution versus hype. In market turbulence, the hype fades fastest. Those with real enterprise AI deployments or clinical trial progress hold up much better. Expect money to flow out of overbought story trades and into quality names that are temporarily unloved but fundamentally sound. Then strong players may now step in, acquiring distressed innovation assets at a discount. That creates optionality. We would be watching Warren Buffett and what does he do with his cash chest or war chest, as you may call it. So what should we as retail investors do? I think first we shouldn't panic sell. Broad emotion-driven selling often presents opportunities, but that doesn't mean throwing money away at everything. Here's my approach. I'm going to revisit my watch list, reassess names based on cash, regulatory catalyst, clinical or commercial milestones, and start layering in selectively small positions now, not full allocations at once. And I'm going to focus on downside control, define stop levels, consider hedges, and keep liquidity on hand. In fact, I'm already mostly into cash with a bunch of shorts in place and a few longs, one or two longs. Nvidia, I am long on Nvidia. So I'm going to watch for entry points in developmental names that get oversold or temporarily neglected winners. Throughout, I'm going to keep emotion out of it. At least I'm going to try. And discipline matters most when markets are turbulent. And I think for me, the biggest challenge is that the market is so big. I can't have a scattershot approach of looking at everything. And that's where my watch list comes in. And right now, I think my watch list is also too big and wide. I have to cull it out and make it shorter. But having a smaller watch list gives me familiar stocks. I know the behavior of the stocks for the last 2 years. And I know how they react in various situations. I know the resistances and supports. So I'm very familiar with the chart. So as the chart keeps on unfolding, when we touch past resistance and support levels, my memory triggers what happened at that time, how I felt about it, and what transpired. So it gives me better chance of success with the watch list. And that's what I'm planning to do. This is my approach, not a guarantee. You should always do your own research. What works for you may not work for me. What works for me may not work for you. As a retail investor, I'm just sharing my thoughts and approach out here. I'm curious what's happening in your portfolio right now. Are AI names getting slammed, genomics getting hit harder, or is it just broad weakness? Drop your observations and your moves in the comment just the way I have shared. I want to see what you're reading, and I want to see what you're thinking and what your plan is. If you want more of this calm, data-driven breakdowns in volatile markets, hit the subscribe button. I'll keep bringing you clarity when things feel messy, or at least I'll keep bringing you what I think as clarity. And you can always tell me what you think about it. And together, as a retail investor community, I think we should be able to come out of this difficult situation in a much better shape. And friends, we now have a Substack. Substack is absolutely free. And in the Substack, I have articles that go deeper than the long form videos that I do here, because in Substack you have the luxury of time and you could read that at your leisure while you're traveling in the train or taking a flight or something. Just go into the Substack. Link to the Substack is in the description. It's very simple to remember. ShareTreck.substack.com. Subscribe there. Let me see your name in the subscribers list out there. Thank you so much. Bye for now. I'll catch you again in the next video. See you later.